Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Paris milling wheat and London, UK feed wheat.
Paris milling wheat. 23 weeks ago, part of my musings on the market were thus, and I quote, "We may have another bearish but less aggressively bearish pattern, though not necessarily by much. It is a mid-June to date bear channel, currently 220 to 295, which is highlighted in bright green on my daily chart. I'm not saying either of these two will be the way forward, but if you favour the bearish side, these are worth considering," end of quote. 4 weeks ago, the market created a cusp and we had a break higher as the bearish pressure generated by a now long defunct but pretty pitchfork gave way. We had a resurgence higher, something I'd cautioned on 3 weeks ago. The market rose up through stratified layers of resistance. Some of them seemed and still seem quite dense, such as the congestion area 238 to 242 that contains the March 2013 high at 240, then the declining short medium moving average currently 239, then the February 2013 high at 247, and another congestion band between 250 to 255 with a 2013 high at 253 within it, along with a medium moving average currently also 253. That declined into this area after that, another small congestion area, 258 to 260, with the 2011 high within it at 258, followed by a deserted area up to some of the most heavy-looking congestion available between 267 and 270. Those numbers were enough to go on for now. This week, the open question as to whether the recent move higher was just a recovery or an overtly bearish market, or whether the attempt down in late May and early June down to the 50% absolute Fibonacci line at 219, which is highlighted in purple on my daily chart, whether this move down triggered the beginnings of a new bullish movement. Well, that open question looks like it may be answered this week, as we're on the verge of making a weekly key reversal here this week. Thus, if we close either above 254.5 or under 245 even, then we'd be on. Anything in between and we'd have a lesser outside week. Right now we are looking at a weekly key reversal down, though it is a lot closer to an outside week than I am comfortable with. This leads me now to my final point, the formation of the lip in a possible descending scallop pattern here. I said last week that this daily chart had the makings of a better example of a descending scallop pattern than in the other grains. However, the hesitation to form the lip has been honestly fairly minimal, but this has been offset to a great degree by the potential weekly key reversal down that we may soon be seeing. So it's half a dozen of one and against 6 of the other. To look at this as a completed descending scallop pattern, we are still a way away from. I suspect you'd need to see prices fall to at least the congestion at 227 and maybe as far as the purple coloured 50% absolute Fibonacci line at 219 to even start considering this pattern having completed its construction. UK London feed wheat. Last week I spoke about the construction of a small bullish pattern here. Let me just get rid of that. Small bullish pattern here, a mini reverse head and shoulders pattern. Over a 3-week period, that's either side of the turn of the month from May into June. Now the resultant push higher pushed up over the 50% absolute Fibonacci line at 180.5, and last week over the slowly declining short medium moving average, currently 183.20. However, that was it for the recovery rally from the mini reverse head and shoulders pattern, as prices this week have turned away, back down, not wishing to even look at the next major congestion area overhead. That's the declining medium moving average, currently 198.20. Thus, I started to look at the bigger picture here, and this is different on this daily chart when compared to other grain markets. And by this, I specifically mean the chance of a possible descending scallop pattern. Then I think I would feel obliged to place some potentials below, but at this time the scallop seems limited, especially from the big dip we saw in prices late last week. Additionally, we are still far away from some of the moving averages, notably the long moving average above, currently at 225.20. when compared to the other grain markets, which could indicate a number of differing issues here in comparison to other markets. For example, a slower market development cycle when compared to the others. There may also be factors that could subdue or even hide such ideas as a descending scallop pattern until much later. So where does that leave us now? Well, pushing up through the short medium moving average and the dropping and then drop backing below again after having a fairly clear area topside, well, it clears all the way up to the declining medium moving average. And I have a suspicion the market may be looking to do one of two things. It could be going the conventional way and drop down to the 165 even zone and set up for a completion of a potential descending scallop pattern, or we could see the market move along the one highlighted trend line we do have here, and that's the bright red neckline currently at 178.55 for the mini reverse head and shoulders pattern.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.